Hello, everyone, and welcome to Chapter 5 Job Order Costing for Accounting 3224. So, what are we going to talk about today? So, our learning objectives for today is to describe what really job order costing is. We will be calculating predetermined overhead rates. We'll describe and account for the flow of cost in job order costing system. We'll calculate applied manufacturing overhead. And then we'll look at closing over-applied or under-applied manufacturing overhead. And finally, prepare our cost of goods manufactured and income statement under job order costing. So job order costing. For any manager that is determining the cost of the product or the services, the challenge always is how to determine the cost. Now, that's because some of these costs are fixed, which are not tied to the production level, but it could change the per unit cost. Okay, so in addition to variations in the level of production, there are several different products or services that may be produced in the same period. So, our solution to that is to average some of these costs across the period or across the products and the services. So that is where our job order costing comes into play. So our job order costing is used in situations where you have multiple products, jobs, or services that are produced in each period. And since each job is different, the cost records must be maintained for each of these product or cost. Now, how are we able to do that? So the documents that we will be using to track the cost on job order costing system. So for the direct material piece, we will be using our bill of material. This is a record that will list the type and quantities of each major type of material needed to make a product. On the other hand, our material requisition form is a source document which will specify what quantity of material and what types of material would be drawn from the storeroom and identifies the job to which the cost of these material will be charged to. Then, in order to track our direct labor cost, we use our time tickets or your time cards, or we also call them as time sheets. Okay, any system where you are able to have a detailed source document that can be used to record employees' hours by hour activity during a day. Now, the job cost sheet, a form is prepared for each job that records the material, labor, and overhead cost that is charged to a job. So the way this information flows is actually backwards. So once the sales order is received, once we know the quantities that is agreed to with the customer, we determine the delivery dates, the quantities, quality, price. Once all of that is locked in, then that sales order moves into production order. Okay, so the production order is the initiation of the job where the costs are charged through three main pieces. First one is your material requisition form. The second one is your direct labor or your time tickets. And the third piece is your predetermined overhead rate. Now, these production costs are accumulated on a form which is generally maintained by the accounting department, and that form is called a job cost sheet. So, a job cost sheet contains the unit cost for each of these products. So that is the information the business will use when we determine the ending inventory and cost of goods sold. Now, the steps involved in the job order costing, so primarily on a broader level, there are four major steps. So, step one is calculating the manufacturing overhead rate. We will apply that manufacturing overhead rate, then do the work in process calculation. Step two is to prepare our T accounts. Step three is to look at our manufacturing overhead account and determine whether that is over applied or under applied. So basically, we will have to bring this account to a zero balance so that we can address the leftover cost in manufacturing overhead. Whether that is over applied or under applied, we will deal with that in step three. And finally, our step four is to prepare our schedule of cost of goods manufactured and income statement. So the new material in chapter 5 is step 1, 2, and 3. The preparation of cost of goods manufactured and income statement is what we had discussed in the prior chapter. Now, why do we need to use a predetermined manufacturing overhead rate? When the company is trying to cost a um, um, job or a service, okay, there are two options. One is the company can wait for the actual cost, or the second option is to estimate. Now, if the company waits for the actual cost, then it might be too late because we need to provide our customers with a certain selling price. And in order to determine that, we need to know what it's going to cost us and then inbuild our profit margins on that. So, because of that, we end up using predetermined manufacturing overhead rate. So, this helps the managers in estimating how much a completed job is going to cost before the end of the accounting period. So, this will help them with the planning purposes. So, the components of the manufacturing overhead, such as heating cost, could cause the actual overhead rate to fluctuate. Okay, not all jobs are going to need the same amount of utilities. So, this will lead to different cost being allocated to identical jobs. So, using the predetermined rate would help us keep the records straight and simple. So, why not use the actual manufacturing rates or the cost instead of estimating that? Well, there are various reasons for doing that. One is keep in mind your manufacturing overhead cost is indirect in nature. And as we have established, any cost that is indirect in nature, it is rather difficult to trace that cost to a particular order or a job or a product. Okay. And there must be many different types of cost that goes into manufacturing overhead. Given the nature of that account, that this is indirect cost, there could be different types of cost. When you look at different types of cost, there would be different timings of payments as well. Some of these costs might be paid on an annual basis, some might be paid on quarterly, others are paid monthly. Okay, so your MOH trend to stay relatively constant, it is including several fixed costs where your production may vary due to the seasonality. So your fixed cost is not going to change, but your production level does keep changing. So, because of these challenges, we use the estimated manufacturing overhead rate. Now, in order for us to calculate our estimated manufacturing overhead rate, we need to have an allocation basis, which is a measure of activity, such as our direct labor hours or our machine hours, on which we can then assign the cost to these cost objects, which is a job or a product. A bit more about the allocation basis is, generally speaking, your budgeted direct labor hours is the most common allocation basis that is used. And most exercises and problems in your textbook will use the budgeted direct labor hours for allocation basis. But there are other bases that are available in the industry which are good to know, such as your direct labor cost. You could have your direct material cost, your machine hours, or it could be something industry specific, such as the occupancy for the beds or the flight hours. All in all, the bottom line is read your question carefully to see how the company is allocating the manufacturing overhead rate. What's their allocation basis used? So moving on to step one, which is our manufacturing overhead rate calculations. So we will calculate the predetermined manufacturing overhead rate if this is not already given. So when you're looking at your question, sometime this information is stated, other times you would be expected to calculate that. Now, when we are calculating this rate, generally speaking, this rate is established at the beginning of the year. So we will look at our estimated manufacturing overhead, total manufacturing overhead that is estimated for the whole year, and divide that by the budgeted hours, okay, which is your allocation basis. Now, let's keep in mind that our manufacturing overhead tends to be constant for the most part. There might be some smaller variations, but for most part, this tends to remain quite constant. Okay, so we will look at our estimated manufacturing overhead, total dollar, divided that by our allocation basis, which is budgeted hours. Once we know our predetermined manufacturing overhead rate, then as we go, we will keep applying this manufacturing overhead based on the predetermined rate. So whatever your predetermined manufacturing overhead rate is, we will multiply that by the actual number of hours and apply that cost as applied manufacturing overhead to that job or product as we go. Now, calculating the work in process, either we might be calculating the beginning work in process, we might be calculating ending, or we might end up calculating both. It's a fairly easy process. Now, what goes into your work in process? Your work in process are the items that are still on your manufacturing line, which are not converted into finished goods yet. So we are trying to determine the total cost associated to these items which are still on the production line, which makes up your work in process inventory. So the three elements that will go into your work in process inventory is your direct material, which is often stated, your direct labor. Either this information is given or we will have to calculate that. So either the dollar is given or the number of hours that we have spent in terms of the direct labor on work in process inventory is stated. So if you know the hours and the labor rates, then we can multiply them and calculate our direct labor cost. The third piece to your cost for work in process above your direct material and direct labor is your applied manufacturing overhead. So our manufacturing overhead rate that we had calculated initially in step one, that is multiplied based on our labor hours in the WIP, which is your work in process. So a combination of all of these three cost elements, your direct material, direct labor, and your applied manufacturing overhead, will give you your total work in process inventory. Let's look at example E5-2. So Weaver Company predetermined overhead rate is $18 per direct labor hour, and its direct labor wage rate is $12 per hour. The following information pertains to job A200, where we know that the direct material on job A200 is $200 and direct labor is $120. So we are calculating the total manufacturing cost assigned to this job A200. And if job A200 consists of 50 units, what is the average cost assigned to each unit included in the job? Now, your total manufacturing cost, if we recall from our earlier learning, is direct material, direct labor, plus applied manufacturing overhead. You can also think of your cost of goods manufactured when you're thinking of this concept. That's where your total manufacturing cost is coming from. Cost of direct material, cost of direct labor, and applied manufacturing overhead. You can look at the total manufacturing cost as a unit or for a particular project, but conceptually it remains the same. So in this instance, we know that our direct material is $200. We know the direct labor or the money spent on this job for direct labor is $120. The question is, what is our applied manufacturing overhead in this case? Because a combination of those three is what's going to make our total manufacturing cost. Now here we know that the predetermined overhead rate that is already established by the company is $18 per direct labor hour. So the basis, the allocation basis the company is using here is direct labor hours. So all we got to do is determine how many direct labor hours were spent on this job. Okay, we already know the rate for the for the predetermined manufacturing overhead. We also know that our labor wage rate is $12 per hour. So if our total labor cost is $120 and our per hour labor rate is $12, then $120 divided by $12 per hour tells us that we have spent 10 hours on this job. 10 direct labor hours were spent on job A200. If 10 hours were spent, and we already know that our predetermined manufacturing overhead rate is $18 that was pre-established, then our applied manufacturing overhead is $10 hours times $18. So $180 of applied manufacturing overhead added with the direct material, direct labor, and gives us a total manufacturing cost of $500. So that takes care of part one, which is your total manufacturing cost, which is direct material, direct labor, and applied manufacturing overhead. Now for number two, if job A200 consisted of 50 units, what is the average cost assigned to each unit included in the job? So if our total cost is $500 and there are 50 units in this batch, then the average cost per unit is $10 a unit. That brings us to step two, which is T accounts for cash flows. Now, typically when we are completing the job order costing process, we tend to stick to these 7 T accounts. Okay, which are your raw material, manufacturing overhead, work in process, finished goods inventory, cost of goods sold, sales, and operating expenses. The way I think of my T accounts is I look at my inventory. So 3 types of inventories: raw material, work in process, and finished goods. That's your 3 T accounts. Then I think of my income statement. What comes from my income statement is my sales and my cost of goods sold and my operating expenses. So that gives you your 6 T accounts. The 7th one is your manufacturing overhead. Okay, so that is how I like to remember my T accounts just so that I'm not missing any. For this process, we are only using these 7 T accounts. In reality, there could be more T accounts, but this is the bare minimum to complete our job order costing process. So let's see how the information is going to flow amongst these accounts. So when we record these transactions, and here we are trying to highlight the change or the impact on these 70 accounts when we go through the transactions. So when we are purchasing raw material, and some of this is very conceptual and it's coming from your fundamental understanding of journal entries and how the information is flowing from accounting 2121. This is more of a refresher. So when we are purchasing our raw material, your raw material is an asset account that's going up. So we would debit our raw material inventory account, and our liability, which is your accounts payable, is going up. So we are going to credit the liability account. When this raw material is moving into the production line, now raw material could be of two types. It could be the direct material and it could be the indirect material. When we initially purchase the raw material, at that point in time, we do not make a distinction whether your raw material is direct or indirect. It will all go through the raw material inventory account, which is a debit, whether your material was direct or indirect. That distinction, sorry, is only made when we move that raw material, when the raw material is requisitioned into manufacturing, that is when we make the distinction whether your material is direct or indirect. So your direct material will become part of your work in process inventory. So work in process inventory is going up, we are debiting that, which means our raw material inventory is going down, so we are going to credit that account. Now that is only if your raw material was direct. If your raw material is indirect, then instead of going to work in process, it goes to manufacturing overhead account. So we will debit manufacturing overhead and credit raw material inventory account. So under item 2 and 3, we are still crediting raw material inventory account because that account is coming down. So that distinction is only made when the material is requisitioned into production. So depending on whether it's direct or indirect, the direct material goes to work in process, indirect material goes into manufacturing overhead. Okay, again, keep in mind your manufacturing overhead captures your indirect cost, okay, amongst the other cost. Then if we have direct labor cost, now your labor cost could also be direct as well as indirect. So the same idea would apply here as well. If your labor cost is direct, then we would debit work in process inventory and credit your salaries or wages payable. If our uh, labor cost is indirect in nature, then this will also go to manufacturing overhead account, which is debited, and we are still crediting wages or salaries payable. So anything direct, direct material, direct labor, goes to your work in process inventory account. Your indirect labor and indirect material goes to your manufacturing overhead account. Now, when the cost is incurred for your manufacturing overhead account, the actual cost comes into play. Now, let's bear in mind there are two aspects of your manufacturing overhead cost. One is what you are applying, the other is what is actually incurring. Okay, so when the actual cost incurs, we would debit our manufacturing overhead cost, which is actual cost, and we will credit various accounts such as your taxes payable or your utilities payable or your accounts payable. It could be different types of liability accounts that we are crediting, but the debit goes towards your manufacturing overhead account, which is actual. when we are applying our manufacturing overhead using the predetermined rate. Now, whatever we have seen up until step 6 was the actual manufacturing overhead cost. Step 7 is the application of your predetermined manufacturing overhead rate. Now, when we apply this rate, we use the allocation basis, multiply that with our predetermined manufacturing overhead rate that was established in step 1. The journal entry to apply that is your work in process inventory is debited, and we credit our manufacturing overhead account. Okay, so this is the application piece. That's why manufacturing overhead account is being credited. And once your goods are ready, okay, once your goods are completed, they are completely manufactured and they become finished goods, that's when we move them out of work in process and into finished goods inventory. So your finished goods inventory account goes up, so that's why we are debiting that. And your work in process inventory account comes down, which is a credit. Okay, so just a quick reminder here. So actual overhead costs are not charged to the jobs. The actual overhead costs do not appear on the job cost sheet, nor do they appear in work in process account. Only the applied overhead cost based on the predetermined overhead rates appear on the job cost sheet and in work in process accounts. And finally, once your goods moved from the work in process into the finished goods, the ultimate goal is to sell these items. So when these items are sold, they will move out of the finished goods account and we will recognize sales. Now, when you're recognizing sales, there are two aspects of that. One is to set up our accounts receivable and credit the sales account, which is tied to your selling price. But on the other hand, we also have to adjust our cost of goods sold and our finished goods inventory account. So cost of goods sold is debited and finished goods is credited. So we are bringing down our finished goods inventory down because these goods have been sold and they are not available anymore. So jumping into E5-4. So Lancaster Company recorded following transactions for the just completed month. So A, 45,000 in raw material was purchased on account. 125,000 in raw material was requisitioned for use in production. Of this amount, 70,000 was for direct material and the remainder was for indirect material. C, total labor wages for 212,000 were incurred. Of this amount, 183,000 was for direct labor and the remainder was for indirect labor. Additional manufacturing overhead cost is $189,000 were incurred. We are recording these transactions in journal entries. So let's get to that. So A, $45,000 in raw material was purchased on account. Now, when you're purchasing your raw material, as we indicated earlier, we do not make any distinction of whether this is direct or indirect when you're purchasing. So it all becomes part of your raw material inventory account. So that account is debited and we are crediting accounts payable for $45,000. Now, $125,000 in raw material were requisitioned for use in production. So this $125,000 worth of raw material is moving into production line. At this stage, we will have to look at direct and indirect so that we can cost it accordingly. Anything direct will go to your work in process, indirect will go to your manufacturing overhead account. So here, out of $125,000, we know $70,000 was for direct material and the remainder is for indirect material. So $70,000 will go to your work in process inventory because that's the direct material. The indirect material, which is the difference between $125,000 and $70,000, becomes part of your manufacturing overhead account for $55,000. We credit our raw material inventory account since that is going down. Our total labor cost was $212,000, of which $183,000 is for the direct labor and the remainder is for indirect labor. So the same idea with direct and indirect as raw material applies to labor as well. So our direct labor cost of $183,000 is debited to work in process inventory. Our indirect labor, which is the difference between 212,000 and 183,000, goes as a debit to manufacturing overhead account, and we are crediting our salaries or wages payable liability. Our additional manufacturing overhead cost is $189,000 were incurred. So this will be a debit to manufacturing overhead account and credit to various liabilities account. We just don't have enough information to know what that is. That brings us to step 3, which is dealing with the over-applied or under-applied manufacturing overhead. Now, if you conceptualize your manufacturing overhead account, what you see on the debit side or on the left-hand side of your T account is your actual cost. What you see on the credit side of your manufacturing overhead account is the applied manufacturing overhead. So at the end of the period, we look at the ending balance in our manufacturing overhead account to see whether it was over-applied or under-applied. If your manufacturing overhead account was under-applied, then we will debit our cost of goods sold, credit our manufacturing overhead account to bring this account to a zero balance. So we will absorb the cost as part of doing business, which is your cost of goods sold. Keep in mind, this is at the end of the period, so there is no way we are able to go back and recover this cost out of our customers. Okay, so we are closing out our manufacturing overhead account, the overage and underage, at the end of the period. By this time, likely your jobs have already closed, you have billed, and you have received the money, right? Even if you did not, you cannot go back and make those changes. So we absorb the under-applied manufacturing overhead as cost of doing business through cost of goods sold account. So the journal entry is easy peasy. We debit cost of goods sold account and we credit manufacturing overhead. This will bring your manufacturing overhead account to a zero balance. On the other end, though, if your actual manufacturing overhead is higher than the applied, uh, it's lower than the applied, then we are looking at over applied. So if your applied manufacturing overhead is higher than the actual, or your actual is lower than the applied, then you are looking at your over applied manufacturing overhead. Now, over applied manufacturing is a little bit different. Here, we will have to adjust our work in process inventory, our finished goods inventory, as well as your cost of goods sold, given how your inventory moves. So your inventory moves from work in process into the finished goods, from finished goods into cost of goods sold. Okay, so any over application of manufacturing overhead on those jobs would have impacted all of these three accounts: work in process inventory, finished goods, as well as cost of goods sold. So if we debit our manufacturing overhead account and credit all of these three accounts, then we will bring the manufacturing overhead account to a zero balance. Now, how do we do that? So the process of over application is not as easy as under applied. So here, if you have over applied your manufacturing overhead, then we will have to prorate the manufacturing overhead that was over applied between ending work in process, ending finished goods, and cost of goods sold. But cost of goods sold has to be adjusted for beginning work in process and beginning finished goods inventory. So we will prorate amongst these accounts. That brings us to example 5-3. So in this case, we are computing the company's predetermined overhead rate for the year. We are calculating the total overhead applied, and we are determining the amount of under or over applied overhead in the year. So Logan Products computes its predetermined overhead rate annually on the basis of machine hours. So the allocation basis this company is using is their machine hours. At the beginning of the year, it is estimated that its total manufacturing overhead would be $348,000, and the machines would be run a total of 20,000 hours. Its actual total manufacturing overhead for the year was $336,400. So you only know the actuals at the end of the year. And its actual total machine hours worked is 19,500 hours. So let's get on with our calculation. So in order to determine our predetermined overhead rate, this company is estimating their total manufacturing overhead rate at the beginning of the year to be $348,000. Their allocation basis is machine hours, and in this year, the company is estimating that they would run for 20,000 machine hours. So total estimated manufacturing overhead cost of $348,000 divided by 20,000 direct machine hours gives us a predetermined manufacturing overhead rate of $17.40 per machine hour. Now, as we go through the year, as the machine hours would have come into play, we would have applied $17.40 of rate to each machine hour that was worked. All in all, as of the end of the year, if we worked 19,500 hours, each hour was applied at $17.40 of machine hour rate that was predetermined. So far we have applied a total manufacturing overhead cost of $339,300. That is what was applied. But when we get to the end of the year, we recognize that our actual manufacturing overhead cost was $336,400. Since our actual is lower than our applied, we have over applied the manufacturing overhead cost by $2,900. Our actual cost, manufacturing overhead, worked out to be lower than our applied manufacturing overhead. So we have over applied by $2,900 in this case. Another example, E5-5. So we are determining the amount of manufacturing overhead applied to units of product during the period, as well as the amount of over or under applied overhead for the period. So Carrera Corporation uses predetermined overhead rate of $23.10 per direct labor hour. So in this case, we don't have to calculate the predetermined manufacturing overhead rate because it's already stated. The company is also using the direct labor hours as their allocation basis. So this predetermined rate was based on 12,000 estimated direct labor hours and 227,200 of estimated total manufacturing overhead cost. So you can determine how they have calculated the predetermined rate. So basically, it's the total cost of 227,200 divided by the estimated direct labor hours in the year of $12,000. Sorry, of 12,000 direct labor hours gives you a predetermined manufacturing overhead rate of $23.10. In this case, it's stated, but if it wasn't, then you had enough information to calculate the rate. The company incurred actual total manufacturing overhead cost of $296,000 and 12,600 total direct labor hours during the period. So, how much of your manufacturing overhead was applied based on the predetermined rate? So, our predetermined rate of $23.10. So, as we go, we would have applied that to 12,600 direct labor hours during the year. So, all in all, during the year, we have applied $291,060 of applied manufacturing overhead. The actual manufacturing overhead came out to be $296,000. In this case, your actual manufacturing overhead is higher than what we had applied during the year. So we are looking at underapplied manufacturing overhead, which is $4,940. Now, how do we prepare a journal entry to record this? We would debit our cost of goods sold, credit our manufacturing overhead account for the difference, which is $4,940, to adjust for the underapplied manufacturing overhead. This journal entry of debiting cost of goods sold, and debiting manufacturing overhead account will bring the manufacturing overhead account to a zero balance. So this is a quick summary of our overhead concepts that we have talked about so far. So at the beginning, the first step is you're estimating the total manufacturing overhead cost. That is divided by your allocation basis, whether that is your direct labor hours or your machine hours or some other allocation basis. That gives you your predetermined overhead rate that will be used during the year. That predetermined overhead rate multiplied with the actual total units of the allocated base incurred during the period gives you your total manufacturing overhead that will be applied in the period. So at the end of your period, you look at your actual manufacturing overhead cost minus what was applied during the year to determine whether we have over-applied or under-applied manufacturing overhead. Now, if this was over-applied, then we will have to prorate the difference between work in process inventory, finished goods, as well as cost of goods sold. If this was not over applied, then we will write it off to our cost of goods sold. Okay, so in most examples, we are using the budgeted or estimated amount of allocation basis, which is your budgeted direct labor hours. But if the budgets change from year to year, the MOH rate will also vary from one year to the other. So the solution to this is to use capacity as the denominator for calculating manufacturing overhead rate. Now, results will be more consistent when it comes to MOH rate, but MOH, the total manufacturing overhead that is applied, will always be underapplied. And the reason for that is because most companies do not operate at their full capacity. Okay, so what we are doing here is we are using the capacity to determine our manufacturing overhead rate that is predetermined. But because the companies don't usually operate at full capacity, you would end up with underapplied manufacturing overhead. So using the capacity to calculate MOH rate will help you improve decision making. However, the companies cannot use this approach for external reporting purposes. So that brings us to problem 5A-2. So Elderberry Recording Inc. is a small audio recording studio. The company handles work for advertising agencies, primarily for radio ads, and has new singers and bands as clients. Elderberry Recording handles all aspects of recording from editing to making a digital master from which CDs can be copied. The competition in the audio recording industry has always been tough, but it has been getting even tougher over the last several years. The studio has been losing customer to newer studios that are equipped with more up-to-date equipment and are able to offer very attractive prices and excellent service. Summary data concerning the last 2 years of operation follows. So we have the comparative data for 2013 and 2014. The estimated hours of studio service is provided, estimated studio overhead cost is given to us, actual cost of studio services provided, actual studio overhead cost incurred, and hour of studio service at capacity. The company applies studio overhead to recording jobs on the basis of the hours of studio service provided. For example, 30 hours of studio time were required to record, edit, and master the Fire Music CD for a local band. All of the studio overhead is fixed, and the actual overhead cost incurred was exactly as estimated at the beginning of the year in both 2013 and 2014. So required, Elderberry Recording computes its predetermined overhead rate at the beginning of the year based on the estimated studio overhead and the estimated hours of studio services for the year. How much overhead would have been applied to the fire job if it had been done in 2013, in 2014? By how much would the overhead have been underapplied or overapplied in both of these years? So let's look at that. So our predetermined rate, that is not stated here, but we have enough information to calculate. So our total manufacturing overhead cost, which was estimated, was $90,000. If we look at the estimated production, I'm going to go back here. So the estimated hours of studio service is what we are using. In 2013, the company was estimating 1,000 hours, and in 2014, 750 hours. That is what we are using here to calculate our predetermined MOH rate. So in 2013, 90,000 divided by 750 and 90,000 divided by 1,000. Okay, so in 2013, 90,000 over 1,000 hours gives us $90 of predetermined rate, and in 2014 we get $120 per hour rate. Now the actual studio hours were stated. So in 2013 we had 900 actual studio hours, and in 2014 we had 600. So the applied manufacturing overhead would be these actual hours times the predetermined rate of $90. So in 2013, $90 times the 900 hours gives you applied manufacturing overhead of 81,000, and in 2014, $120 rate times the 600 hours gives us applied manufacturing overhead of $72,000. Now, this is what we applied during those years. The actual came out to be exactly $90,000 in both of these years. So, in both of these years, our MOH was underapplied by the difference. In 2013, that was $9,000, and in 2014, it was $18,000 underapplied. The president of Alderberry Recording has heard that some companies in the industries have changed to a system of computing the predetermined overhead rate at the beginning of each year based on the estimated studio overhead for the year and the hour of studio service that could be provided at capacity. He would like to know what effect this would have on job cost, how much overhead would have been applied using this method to the fire job if it had been done in 2013 in 2014, by how much would overhead would have been underapplied or overapplied in either or both of those years. So in this case, we are changing our basis. Okay. Instead of the service hours, we are now looking at the full capacity. So the estimated manufacturing overhead is $90,000, but the total capacity for the business or for the facility is 1,800 hours. So 90,000 divided by 1,800 hours gives us the predetermined rate of $50 in both of those years. Now, the fire job had 30 hours spent on it. Because your predetermined overhead rate is the same in both of those years, your fire job will have the total cost of $1,500 in both of these years. Neither is your cost changing nor is your hour changing. Now, if we look at how much overhead was applied during these years, our actual studio service hours were 900 hours in 2013 and 600 hours in 2014. Those multiplied with our predetermined overhead rate of $50 an hour would have given us applied manufacturing overhead cost of $45,000 in 2013 and $30,000 in 2014. Our actual overhead manufacturing overhead cost is $90,000 in both of these years. So in both of these years, your manufacturing overhead is underapplied significantly. In 2013, the manufacturing overhead is underapplied by $45,000, and in 2014, it is underapplied by $60,000. So how would you interpret the underapplied and overapplied that result from using studio hours at capacity to compute predetermined overhead rate? So when the predetermined overhead rate is based on capacity, the underapplied overhead is interpreted as cost of idle capacity. So that information, the cost of idle capacity, is used or reflected as cost of unused capacity on your income statement. So it would be shown as a period expense. It will be separately disclosed on the income statement as cost of unused capacity or cost of idle capacity, if we are using the capacity to calculate predetermined MOH rate. That brings us to the T accounts. So we are going to look at T accounts and see what they look like. So we're starting with our raw material inventory T account. A quick refresher. So in this case, in job order costing, we will be using 7 T accounts. Think of 3 coming from your inventory account, your raw material, work in process, finished goods. The other 3 T accounts are coming from your income statement, which is your sales, cost of goods sold, operating expenses. So that is your 6 T account. Your 7th T account is the manufacturing overhead account that we have been talking about. So let's see what they look like. So your raw material inventory account. So your beginning balance, it's an asset account, so it should have a debit balance. So we are starting with our beginning balance. Any purchases are added on the debit side. When your raw material is requisitioned into production, then your raw material inventory is going down. Whether that raw material is direct or indirect, it does not matter. Your total raw material inventory is coming down, so we are crediting when the raw material is requisitioned. So it moves out of your raw material inventory account and into your work in process. If you want to conceptualize your journal entries, you would have debited your work in process inventory for the direct material piece and credited raw material inventory. For the indirect piece, you would have debited manufacturing overhead account and credited raw material inventory. So the difference between your debits and credit gives us the ending balance in our raw material inventory account. Your work in process inventory also starts with the beginning balance. The direct material that was requisitioned that moved out of raw material inventory account would have come into your work in process as a debit. Likewise, your direct labor would have come into your work in process inventory account, and your applied manufacturing overhead. Now, once your items are completed, once the final product is ready, then it moves out of your work in process inventory into finished goods. That is when we credit our work in process inventory and debit our finished goods inventory. So this adjustment of unadjusted cost of goods manufactured will then go into your finished goods inventory as a debit. So that gives us the ending balance between the debits and credits as the unadjusted balance. But this T account is also adjusted if you do have over applied manufacturing overhead situation. So if it was adjusted, then we will take the adjustment here. And finally, update the ending balance in our work in process inventory account. It is an asset account, so it should have an ending balance of debit. Our manufacturing overhead account will capture all of our indirect cost, your indirect material, indirect labor, and your other manufacturing overhead costs such as your utilities, insurance, amortization, depreciation, property taxes, okay? Anything and everything that incurs at the manufacturing facility, which is outside of indirect labor and indirect material, then gets captured here. On the credit side of your manufacturing overhead, we will see the applied manufacturing uh, number, which is applied as we go. Now, the difference between this, if your manufacturing overhead account ends up with a debit balance, then you are looking at underapplied situation. If your manufacturing overhead account ends up with a credit balance, then we are looking at our overapplied situation. Either way, whether it is underapplied or overapplied, we will have to bring this account to a zero balance. Once this account comes to a zero balance, that is where you put in your journal entries. If it's underapplied, then you debit your cost of goods sold and credit manufacturing overhead account. If it's overapplied, you would debit MOH account, but credit work in process, finished goods, and cost of goods sold accounts. Either way, manufacturing overhead account has to come to a zero balance once those journal entries are booked. That brings us to our finished goods inventory account. We also start with the beginning balance. Your work in process inventory that is moving out, so the items that are finished and ready, they move out of your work in process inventory into the finished goods. So that is what your unadjusted COGM is. When these goods are, sorry, bear with me here, fat fingers. Okay, so when these goods are completed, they are ready to be sold. And when these goods are sold, then they move out of the finished goods inventory account into our cost of goods sold. So the credit, which is your unadjusted cost of goods sold, is the movement where we are moving our finished goods inventory from this account and now they're sold. So they become part of your cost of goods sold account. Then we will have the unadjusted ending balance in the finished goods inventory. And if there is any adjustment for over applied manufacturing overhead account, then we will bring that in and recalculate the adjusted ending balance for finished goods inventory account. Your cost of goods sold is fairly easy. So once we have sold something, then that inventory moves from the finished goods inventory account into your cost of goods sold. We will adjust for our underapplied or overapplied cost of goods sold or the manufacturing overhead journal entry that would have been booked. And finally, calculate the adjusted cost of goods sold balance. Our sales account has the normal balance of credit. Our operating expenses have normal balance of debit. So all of our selling and administrative expenses will be listed here on the debit side. That brings us to the last step for job order costing, which is preparing our schedule of cost of goods manufactured. Now, this is on a very high level. Your cost of goods manufactured is made up of your direct material, direct labor, and manufacturing overhead. All of those added together gives us our total manufacturing cost. Out of that total manufacturing cost, if we add the beginning work in process inventory and deduct our ending work in process inventory, which is the adjusted total coming from your work in process T account that we were talking about, that gives us our cost of goods manufactured. But the detailed schedule looks something like this. So the name of the business, the cost of goods manufactured schedule, and the period that's ending. So the direct material captures the movement in your raw material account. So we start with our beginning raw material account. Then we add our raw materials that were purchases in the period. So the addition of these two gives us total cost of raw material that is available for use. Out of that, if we deduct our ending raw material inventory, then we would have the resulting number, which is your raw material used in production. Now that is your total raw material used in production, but we only need the direct. So we are going to deduct the indirect material here to determine what was your total direct material used. So the only new thing you're seeing here in comparison to your cost of goods sold manufactured from prior lesson is adjustment for indirect material. Once we know what our total direct material is, then we can move on to our direct labor. Direct labor is fairly easy, which is your wages paid minus your indirect labor. Okay, make sure to adjust only for direct labor. If we have the total labor cost, then we will have to adjust or take out the indirect labor piece so that we can only account for direct labor. And then comes our manufacturing overhead account, which will capture all of our indirect cost, which is your indirect labor, indirect material, and other manufacturing cost. So this is where we bring in our indirect material, indirect labor, your factory rent, utilities, depreciation, all of those accounts come here. That gives us our total manufacturing overhead cost, which is made up of direct material, direct labor, as well as total manufacturing cost. If we add our beginning work in process and deduct our ending work in process, which is adjusted number from your T account, then we would have the resulting cost of goods manufactured in this case. And finally, we will prepare our income statement. So your income statement on a basic level is your sales minus your cost of goods sold gives us our gross margin. Out of the gross margin, if we deduct our operating expenses, then we are looking at operating income. And out of that operating income, if we deduct our income tax expense, then we will have resulting net income. The detailed schedule of your income statement looks like this: name of the business, name of the financial statement, which is income statement here, and for the period ending. We first have our sales revenue. Our cost of goods sold section is detailed here, so we are capturing the changes in our finished goods inventory account at this stage. So we start with our beginning finished goods inventory. Then we add our cost of goods manufactured, which is coming from your cost of goods manufactured schedule that we just prepared. That gives us our total cost of goods available for sale. Out of the total cost of goods available for sale, if we deduct our ending finished goods inventory that is still on hand, then we would have our cost of goods sold. Our sales minus our cost of goods sold gives us our gross margin. Out of that gross margin, once we deduct our operating expenses, which are into two categories: selling and marketing expenses and the administrative expenses, make sure to show your total operating expenses. So total operating expenses deducted out of your gross margin gives you your operating income. The only other piece we need to account for is your income tax expense. Once we account for that, the net difference is our net income. So this is the example we will be discussing in our live session P5-18. But this is all I had for the topic on job order costing, Chapter 5 for Accounting 3224. I will talk to you guys in the live session. Thank you for listening.